This is the fourth annual MIT Club of Northern California Clean Tech Investing Program for what clean tech investing is going to hold in the following year. And first I'd like to introduce Leif Vitito, who is our host from Silicon Valley Bank.
Thanks, Larry. So my name is Leif Vitito. I'm a vice president here at Silicon Valley Bank in our energy and resource innovation team. Despite the little bit about the very brief commercial, SVB is a full-service commercial bank focused on the technology and innovation sector. So all of our client companies, regardless of stage, geography, industry vertical, are somewhere on that proprietary technology innovation spectrum. Despite the provincial-sounding name, we're bigger than just Silicon Valley, though you are in our headquarters. But we've got 30 offices around the country, and India, Israel, China, and the UK as well. And I couldn't remember until Larry just mentioned it, whether this was the third or the fourth year, but we've now hosted this, and this will be the fourth time. A real privilege to have this event here, and it's been an interesting and engaging conversation each year, and a topic that's really important and close to my heart, and clean tech innovation and investing. So thank you all, and I will turn it over to, I turn it back to you or to Eric? Okay, Larry.
So thanks, Leif, for making this facility available. It's a spectacular facility, and the club really appreciates it, as does all of us, as do all of us. So as I said, good evening, fellow entrepreneurs. So let's get the blood flowing. Everybody put their hand up. Have a little exercise, right? Everybody raise their hand. Okay, a yellow shirt, come on, hand up. Okay, so if you are an entrepreneur, or you're becoming an entrepreneur, or you hang out with entrepreneurs, or you're joining a team full of entrepreneurs, or you want to fund an entrepreneur, keep your hand up. God, this is just great. Boy, this is what I'm talking about. All right, we got the right audience. All right. So entrepreneurship is pursuit of an opportunity without regard to resources currently controlled. So that's the operative phrase. So we're doing things a little different this year. You know, the rumor is that the traditional VCs have left the room along with Elvis, and yet there are still many different sources of funding available for startups. You know, so there's product revenue from companies. There's your own savings. There's friends, family, and fools money. There's angel capital. There's still some, and we're going to hear from one of them tonight, some VCs in the business. There's grants from government, local and state and federal government. There are prizes from organizations that give out prizes. There's foundation money, family organizations. There's project finance and venture debt. And so there are many different. Oh, and corporate strategics. How can I forget that? We've got two great corporations here tonight to talk about what they're doing in this space. And then we had a surprise. Panelist who had to drop out at the last minute. He's in your program, Bruce Bauer, and he has his company, Global BSN, has a really innovative approach, starting with customers, letting customers define the problem, and then building a company around that. And so we'll miss that, but that's available. So let me get off the stage here and introduce Eric. Right. So Eric's our moderator. So you all know Eric, right?
Good evening, hello, and thanks for Larry for allowing me to moderate the panel. A quick bit of ancient history. In 2008, venture capitalists invested $8 or $9 billion in the clean tech sector. And over the course of 2006 to about 2010, they invested $25 to $30 billion in the clean tech sector. Unfortunately, many of them did not know what they were doing. And a lot of money was lost, a lot of companies were founded, a lot of companies were petered out. You can read my columns to find out the death list of solar companies. And so we ended up in a point where traditional venture capitalists ran away from this market at the behest of their investors, the limited partners. And so the mistakes they made, they underestimated the amount of time it would take to bring solar, biofuels, lighting, water technologies to market. And so that's the situation we're in. I want to make 3 points. I want to say that despite all of the press and those damn journalists saying that venture capital has been a failure, I would suggest that it's been an absolute success. My metrics are slightly different than the LPs or the VCs. But I would suggest that a company like Solar City, Sunrun, and Sungevity have absolutely disrupted the solar industry. They're making enormous amounts of money, and in the case of Solar City, they have a market capitalization of $5.6 billion. Tesla has a market cap of $28 billion, and companies like BMW and Mercedes-Benz are being disrupted, and that entire industry is being disrupted. So an argument could be made that venture capital has served and has had immense successes. It may not be in the wallets of limited partners, but it's actually absolutely disrupted markets. So I'd make the point that venture capital has actually worked. I'd also make the point, and this is a bit of a tragedy, and so we're talking about energy here. There's a $300 billion electrical industry that is undergoing the biggest set of changes in this decade compared to its 100 years of incumbency that it's had prior. I don't think that's arguable. I think that's the kind of changes we're seeing. And it's in this type of dynamic where there's a volatile industry that's the power shift is not just I'm talking about the power that people have to make their own energy decisions is changing, just like it did with computers, just like it did with cell phones. This is the absolute best time to be an entrepreneur and an investor. It's in a market that's recalibrating, that's changing, and fortunes are going to be made and lost, and yet venture capitalists are on the sidelines in this instance. It's a sad thing. It's a tragedy. And lastly, my third point, everybody wants to hear lastly. Any speaker that wants to hear that. Venture capital is not that big an asset. It's a $25 billion asset class. It's considerable, but that $25 billion is spread out over scores of venture capital firms. It's dwarfed by private equity and project finance, by sovereign wealth funds, by all of the new monetary tools that are coming to the fore in renewables, like asset-backed securities, perhaps MLPs and REIT. So there's enormous, and Larry gave a long list of other sources of funding that besides that, I don't want to minimize it, but it is just one piece of the financial asset class, venture capital. And so we have a great diverse panel of folks who are not in the traditional venture capital world, and we're going to hear from them. So let's start, Jeff, on the, I'm not going to read their bios. Just Jeff alone, he's been in the energy market for 300 man-years, and it just would take too long. So, and he'd do a better job of it than me. He's seen I can keep going. He's seen the transit from wood to coal and steam. And so he's who better to talk about the Vaclav-Smil type of transition that's going to happen in the next couple of years. I'll shut up. So tell us in 4 minutes what your organization does, and answer me this. Are we going to ever see venture capital have a year like 2008? Is there ever going to be $8 billion coming from the venture capital asset class like it was in the heady, stupid days of 2008?
Okay, and just in case I forget to answer that at the end, the answer is yes.
Okay,
okay.
We will.
Absolutely,
will see.
absolutely.
Okay. Tell me about
once there's a lot of money on the table, they'll be back. All right, so 4 minutes. Thank you for inviting me here. I'm a rookie, really, in the investment sector, and I'm looking forward to learning a lot from my fellow panelists. And of course, I've always wanted to be on a panel moderated by the illustrious Eric Wesoff. So, full disclosure, I'm wearing a hat because I had one of these light treatments done to my face as a preemptive strike against that precancerous stuff. And it detracts from my appearance to look how bad I look. So the other is that I'm getting out of the investor space this next year. I should also fully disclose I've been accepted to be in part of the inaugural cohort of the Stanford Distinguished Career Institute next year. Don's laughing over there, I can see. And as soon as I figure out what that is, I'll tell you. But that means don't chase me afterwards for investment opportunities, okay? I've been associated with the Band of Angels for a couple of years. I'm also the vice chair of the board of the Greentech Open, and I'd like to bring up a third option too. And so I'll just cover them all very quickly, and you can ask me about them later on if they interest you. First of all, let me ask, of the hands that were up earlier, anybody who's here that's an investor? Maybe you don't want to identify yourselves. Who's here that's looking for funding or may be looking for funding in the future? That's kind of what I thought, and that's kind of the breakdown that I thought we might see here today. So I just want to cover briefly, the band has been, I think it's probably the oldest organized group of angel investors. It's been around for about 20 years. And I got lots of numbers and statistics that I can give you, but in general, they've seeded almost 300 deals. They've put together about $230 million worth of investments and a lot of acquisitions, about 10 successful IPOs. The Greentech SIG, I've got some, the Clean Technology and Energy Special Interest Group, of which Larry Kelly is our chair. I've got some numbers on that as well, but I think the most important thing you should know about the band is that our work really starts once we write the check. That we're interested in engaging with companies and helping them be successful as mentors, connectors, and even if we don't write the check, we try and fulfill those different roles. Interest of time, I'll move to the Greentech Open real quick. Now the Greentech Open is we think it's the world's largest accelerator of clean technology startup companies. It's been around for about 8 years. I've been on the board for about 4. I co-chair the board. We say we find, fund, and we foster, find, fund. These 3 F's. But we really don't fund anybody. We give you exposure. We give you visibility. We give you credibility. And the companies, of which there's been about 850 that have been through our program, to a company, they all talk about that it's gotten them on the right track. It's gotten their message solidified. They've been able to raise those companies over $1 billion of outside funding. And we haven't had any enormous successes yet, but we've had some. And it's national, and we're going global. So the reason I bring it up is because the companies that have been through there have done pretty well. Oh, we do give a $200,000 prize to the ultimate winner, but I think there are some other benefits as well. And one, in my last 30 seconds, having been a former energy commissioner and chaired the R&D division at the commission, we used to have a thing called the Public Interest Energy Research Fund. It's now called EPIC, which stands for Electric Program Investment Charge. I mention this because this is a source of $162 million a year of undiluted funding that's purpose is to assist the development of non-commercial, new and emerging clean technologies in California while providing assistance to commercially viable projects. That's a pretty sizable chunk of change. Of course, we tend to favor California companies, but this is the kind of thing you might want to consider going after. I'll be glad to mention more, and my favorite program at the Energy Commission is the Energy Innovation Small Grant Program. These are $150,000 kind of grants that are geared towards academia, basic research, the kinds of things that, if it's successful, tends to percolate into more grants. 4 minutes?
4 minutes only if we're traveling at superluminal speed. But we're losing panelists rapidly, so we need you here. So, Kacy, tell us a little about what you're doing at ARPA and where it fits into the entrepreneurs funding.
Sure. So my favorite thing at CEC is the matching program they have for ARPA-E awards.
I'll bet.
Which is also really good, and you should look into it.
And let me make the distinction. You're an angel group. I'm sure most of us are fluent in this, but you're investing your own money as opposed to a venture capitalist investing limited partners.
Correct. Angel
right?
investors write their own checks.
And like you said, you're taking a very, very deep interest in the company, which is exactly the type of board member the VC doesn't want to have, right?
You're not going to get me to say negative things about VCs.
So I guess I'll give like the 2-minute story on ARPA-E. I think most folks know that we're modeled after DARPA. DARPA came about in the Sputnik days when the military saw a satellite flying through the sky and said, "Hey, that's not our technology. Maybe we're falling behind here." And so they established DARPA. Fast forward to 2006, we have the Rising Above the Gathering Storm report, which concluded that there's a big wave of clean energy technologies coming and that it's critical to our national security, our environmental security, and our economic security, and that we might be falling behind on that. And so they established ARPA-E. Our mission is pretty clear. We're supposed to fund non-incremental technologies that are off anyone's current roadmap, over the horizon, disruptive, high-risk energy technologies, and we fund across the entire energy space. So, fuels, natural gas, magnets, renewables, agriculture, robots. Fusion now. And we fund through the main lens of impact. So we have 3 main goals: reduce energy, reduce imports, reduce emissions, and increase energy efficiency throughout our domestic base. And every program we fund and every individual project we fund is measured based on that lens. If this technology is wildly successful, then how many quads of energy can be saved? We're $280 million per year agency, and we give out cooperative agreements, which are kind of like grants, except we work a lot more closely with our teams through focused programs in a variety of different areas, and then also through open solicitations. So we have an open solicitation that's going to be coming up this January. You should look out for it. And it just says, give us your best ideas in energy US. But it's super competitive. Last time we ran one of those solicitations, we got over 3,000 applications. Each one of them was heavily due diligenced and peer reviewed, and we selected 66. So I think that might be one of the most competitive solicitations in the US.
Kacy, what's the size of the typical grant?
Yeah, typically they're 1 to 3 million. We can go all the way up to 10 million. Because we have, like DARPA, we have flexibility in our funding, and they last around from 1 to 3 years, but they could go longer.
Highly milestoned,
Yes.
tranched?
Every month we're meeting with our teams because they have very specific technical milestones, and then they also have specific what we call technology to market milestones. So you have to be doing cost analysis, you have to be talking to customers, you have to be trying to define what the value is more clearly
So do you take
associated with the
a
technology.
company from PowerPoint to prototype, or from PowerPoint to PowerPoint? What is the...
Hopefully not PowerPoint to PowerPoint. So we're more on the applied side. So if you're doing basic science, you should look into the basic science parts of the Department of Energy. We take you from idea, which has been shown to work on paper and doesn't violate any physical laws, to first prototype.
Okay. And this DARPA was the... I'm sorry, but the men who talk to goats, right? So nothing was too... right? Nothing was too... I mean, they would be willing to take very high risks, right? So
Yep.
Give me an example in energy of something within the bounds of propriety that you can talk about that is a far out type of idea without disclosing too much details.
I think
You said
our-
non-incremental.
our latest program that we just launched called Terra, it's on agricultural phenomics. So the robotics and sensors to scan through the field and collect data on plant performance and identify like the hero plants, the awesome plants that are, have the greatest yield, the highest water use efficiency, who are the plants that are using nitrogen most efficiently, and then to link that to their genetics and to do all the computational analytics to bring that together and say, this is the gene that's driving that trait in that plant, and therefore we can increase our breeding throughput and drive higher yielding bioenergy crops.
Great, thank you, thank you. Mark Perutz is a partner at DBL Ventures. I meet with him once a year on a panel for the last 4 or 5 years, so good to see you again. Tell us about DBL. You could be looked at as a traditional venture capitalist. Tell us what makes you a little bit different.
Sure. And it's always an honor to be on a panel with Eric, and thanks to Larry and the MIT CNC folks for having me and all of us here. So DBL Investors is a venture capital firm. We've been making VC investments since 2004. We've got $225 million invested across 2 funds, about 40 portfolio companies, one of which is represented by Brad Madsen of SIVA, thin film solar module company, one of the survivors, Eric. But as I was driving here, I was thinking about what would be the best way to represent, as the sole venture capital representative on this panel with regards to our role in financing clean tech, and I thought probably the best thing I could do would be to not show up. and then I thought probably the second best thing I could do would be to show up but don't contribute anything to the conversation in a meaningful way. But I guess it is good that there's only one of us up here, because it has come down a lot, and I'd say that there's only maybe 10 venture capital firms in the US probably actively making early stage investments in clean tech, narrowly defined. So narrowly defined would be energy generation, like solar and wind, et cetera, or energy management, like demand response or smart grid or storage, just because those industries are so mature. And the opportunity to do kind of a category creating play like a Solar City is not so good, although there's lots of smaller opportunities in there. For example, we invested about 11 months ago in a company called Nextracker, which is next generation ground-based solar trackers. I guess it was kind of a standard round for rounds these days in clean tech, narrowly defined, and that there was a couple of VCs who are still investing in the sector, but also a family office and a strategic, kind of broadening the role.
Is it Dan Shugars?
Yes, yeah. And I guess, outside of the narrow definition where there's just a few VCs in the power generation and power management, there's been a lot of attention of late on kind of more broadly defined in terms of companies that produce products or services that have some sort of resource efficiency or energy efficiency component. Transportation with Tesla and SpaceX. Ag tech and food is huge. We're invested in a stealth. 6 months ago, did an investment in a stealth company in big data for small farmers. The sharing economy and the circular economy is kind of really pushing the boundaries. Is that really clean tech in terms of?
But you haven't retreated to this clean tech light, IT-based. You are willing to look at big metal and energy generation and energy storage and batteries. You're not just doing apps.
Yeah, we are, and maybe 9 or so others are willing to do that kind of, that level of investment where there's a lot of capital, usually some technology risk, a lot of capital required, long time frames to exit, and certainly substantial technology risk and financing risk. Just a minute on DBL. DBL stands for double bottom line. So we invest for market rate of financial return, but we also look for positive social and environmental impact. And that looking for social and environmental impact is exactly what brought us to clean tech pretty early on. Our first clean tech investment was Powerlight in 2005. Obviously, clean tech has the environmental benefit, but also if you're making something that needs to be manufactured or installed, that means usually the creation of hourly jobs, and more we've seen a move towards those jobs being created here rather than offshore. So that's DBL Investors. One other point, we have had some good exits, and that's probably
I think
one of
it's
the
worth
big.
bragging. It's worth bragging about.
And it's also explanatory as to why we're one of the people we're the VC represented on this panel, is that we were very early investors in Solar City and Tesla, which are the only two clean tech exits of anything greater than, well, Nest was at $3 billion, but those are the three greater than $1 billion, and you kind of need those to make the companies that don't work out, to make the fund return what it needs to do.
Okay, and $8 billion in venture capital per year, is that ever going to happen again, or is that just...
I'd say if you go, it depends on the definition, and sometimes you'll see it was probably like $4 billion in someone's narrow definition and $8 billion in someone's broad definition. In either definition, I think we'll get back there, but there's such a lag with venture, because once you haven't had a good track record and you don't raise another fund, or you raise another fund but you promise over and over your LP investors that you're not going to make any of those clean tech investments, then you have a 5-year initial investment period for that, and then you go out and raise another fund.
It's generational, it skips a generation.
Yeah, so I think we're probably a year or two into that 5-year period where funds like ours and a few others may have capital to invest in the now definition of energy generation and management. But I think it's going to be at least 3 or 4 years before we see a lot of other funds come in.
Okay, so now we shift gears a little bit. Mark Pacelle from Philips is more in the corporate investor world. Tell us where you fit in and what your energy thesis, what your investment thesis is.
Sure. Thanks. And thank you, Larry, for inviting me. So I just joined Philips about 6 months ago, which makes me relatively new to the firm. But I came out of the sensor networking world, and I'll kind of tell you why that's relevant here in a second. But I was hired on as the head of or leading open innovation for Philips for North America. And I'm curious, how many people have heard of that term and know what it means, open innovation? Yeah, maybe a third or something. Yeah, I didn't know what it meant either until I was hired. Really there's a transformation happening in big companies. And I think Philips is probably a little bit late in getting onto this bandwagon. Over the past century, and Philips is a 125-year-old company, but over the last century, most big companies have had centralized labs, Bell Labs, Philips Labs, other labs, where they isolate all the smart people out in a really beautiful area of the country and they invent things. And that worked for a while, but in this day and age, innovation is happening elsewhere. And if a company doesn't tap into the innovation that's happening everywhere other than their company, then they're not going to move fast. And this space is beginning to move fast. Lighting is going through a fundamental transformation now. So as a head of open innovation, we look outside of our company, look at research being done at top universities. We plug in very closely with the venture community. We partner with other research institutions, and we look for important innovation that aligns with our corporate strategy that we would like to bring into the company. It could be brought in by us doing just a partnership with a startup or participating in a round of funding. Eventually, maybe that technology is important enough for us to acquire the company. Likewise, we would perhaps fund research at universities. That is important for us to move along our strategic axis. And that's, I guess, why it's relevant for me to be speaking to this crowd tonight. The big change that's happening in lighting and why it's relevant to clean tech is that we are fundamentally going from an analog business to a digital business. We're going from a company like Philips that has spent 100 years making money on replacement light bulbs to now, with the fundamental shift to LED, they don't burn out. And so you're going to have to figure out what to do to continue your business. Other than that, you now are installing an LED device as a silicon device. It's a digital device, which opens up a whole new world. You now, instead of having a boring grid of incandescent light bulbs over your head, you have a sensor network. And with LED lights that are compliant with, say, Title 24 in California, you have embedded occupancy sensors, embedded light sensors, and the lights dim themselves and save energy based on the position of the sun, the presence in the room, and that's only the beginning. Once you start embedding sensors in the lights, you can embed any type of sensor. You're collecting data all the time. You aggregate the data to see patterns of occupancy and movement through a building. You can tap into to do building utilization reports. Say a corporation was leasing 10 floors. Now they say, well, we don't need to lease 10 floors. We can lower it to 8 floors. And again, that's only the beginning. It's going to be intriguing how as the office space across America eventually upgrades to LED lights and embedded sensor networks and fine-tuning of control, what type of insight we're going to get to the operation of buildings. And that's just the commercial buildings. We're also present in street lighting. When you network street lighting together, you then begin to embed sensors to look at congestion, look at crime, look at occupancy, tap it into the traffic lights and make the city more efficient. We begin to participate in smart cities.
Let me interrupt for just a second,
Yeah.
because Mark Perutz, I want to ask you. We've seen some networked LED companies and lighting companies get funded in the last couple of years. Redwood Lighting
Systems.
Networks, they
Redwood
got
Systems,
sold
yeah.
in a non-beautiful exit, and Adura is another one who also, I think, was acquired in a less than VC multiple number. So were those companies way too early, or is now the time? Is that the mistake that $30 billion of venture capital did? Is it came in too early? And because there are companies who were doing networked LEDs, and they were somewhat, they got B and C rounds, but they didn't get the traction they needed, and they ended up retreating into some strategic companies, bowels.
Which Mark?
Is that a question for one of the marks? Or?
Jump on it.
I mean, you kind of answered the own question pretty well. I mean, we looked at both of those deals, Redwood and Adura, early on. I think first, maybe 6 or 7 years ago when they were starting off, and I'm really generalizing here, the traction was slow, and that's why not all VCs kind of hopped on it, and we passed. And then I guess maybe about, you had the whole 2008, 2009 crash, and then valuations cratered, right, for the entire financial world, but for clean tech as well. And then from late 2009 to late 2012, early 2013, you have valuations coming back to where they were pre-crash for the rest of the markets publicly, and clean tech just goes lower and lower and lower until it was, at least the public market indices, it was 20% of the value, so an 80% decline. At the bowels of late 2012, early 2013, and the private markets take their cue on valuation from the public markets because that's where you see the exits and the comps, and so those companies
if Cree is trading at half of what it was trading a couple of months ago, that's going to impact
right,
those private.
and their buying power goes away for acquisitions, so everything just looks grimmer due to valuations, and it's sad because those the problems that are still there in terms of facing our our world, and that's driving clean tech and companies and entrepreneurs, and particularly in the lighting space, as you talked about, that's happening. And those revenues really picked up over the past 2 or 3 years, but valuations, as I'm sure all the hands that went up for entrepreneurs here, they've noticed that valuations have not gone up, particularly in the private markets. So I think you're faced with and not a lot of new VCs to come in. So you kind of have to sell or continue to fund a company that's probably not break even, and that's probably what they had to deal with.
Sure. All right. So that was Philips. I worked for Philips. I think they fired me. Ik spreek geen Nederlands, and now we have Siemens. Also, they fired me a couple of years ago. A number of years ago. Mein Deutsch ist sehr schlecht. That's not true. I retired from those companies. But Farshid, you work in Siemens, but you're not a standard corporate investor. You do something else. You're sort of a partner. And so tell us about that type of business.
Right. Hi, guys. Yes, I work out of office in Berkeley. There's about 10 of us there. We do not invest. So that's just to make that clear. There is a Siemens venture capital that does invest, so they are a typical corporate venture. What we do is we do fund startup companies in order for them to prove their technology. We are an open innovation office, so we've been here 15 years, so you guys are 15 years late. And basically, yeah, so basically, we would like to know if the idea is worth integrating with some part of Siemens. And initially, we think, the 10 of us in Berkeley think, okay, this is worth considering. The product managers think is also worth considering, and they always come with a but. So our money goes towards answering the but. So basically, eliminate the technical risk or reduce it significantly. Validate the business proposition, the value prop that they're saying. And so we do that through talking to some customers sometimes, talking to product managers. And the fun part is when we get to use the idea in something that the founders didn't think it was applicable. So that is always the most fun. But most of the time we end up proving, integrating, testing, something. And
But you're not giving anybody X million for a funding round. It's a specific task. Build this prototype. I mean, give me an example of a particular job. Or
sure. Yeah. So we had two guys came into our office, high school graduate and a PhD in. Actually, he was from MIT. MIT PhD physics. It's an interesting odd couple, and they had this idea to do the solar tracking. And at the time, we were not in Siemens. Siemens is not in doing PV anymore, but at the time we were. So the idea was, okay, what do you have? So what they had at the time was a wooden robot, which they were pulling with a string. And they were showing us how this could actually point the tracker, the solar panel to the sun. Obviously, yeah, it's cool. It could be cheaper, but then, well, we're not gonna take us to anybody in Siemens. So yeah, so we funded them to make the first 2 or 3 versions of the robot, and we did that, and then actually worked very nicely. Our Siemens venture capital colleagues got excited. They put money in, and that worked out very nicely. And then at the end, Department of Energy Sunshot program also funded them. They got lots of funding from NEA. Yeah, it was Cubotics. Yeah, Cubotics. It worked out very nicely, and then we couldn't brag because we left solar business, but I'm still friends with them. But that's an example of a kind of a stage we get involved.
Excellent.
The kind of things we remove. They didn't know some of the things. We put them in touch with our solar guys that were developing projects to go through what it takes to prove that you're financially viable. So that's the kind of thing we do. And we do this in wind, in servicing of wind turbines, gas turbines. We do this in entire transmission of high voltage, medium voltage, low voltage, distribution of power, all the software that it takes to run that. If you have anything in that space, it's quite complicated. And then my colleagues do it for the factory side, all the gizmos that you need to make a factory, all the software you need to run it, design a product. So we do this in all those spaces. We do not do chemistry stuff, so we don't make chemicals. We don't do anything in the house. So if you have a way to turn on the dishwasher, sorry, we cannot use it.
But you don't ask for equity in the company.
We don't ask for equity. We do go to our VC friends and say, guess what we found? Why don't you invest in it? Because we think it's good. And some of them do their own homework, and they do invest. And it's good for them because Siemens is saying it's good. And it's good for us because our money kind of gets multiplied. So it's a win-win situation. I like personally to do it at the height of the optimism, which is right before we sign any contract. Everybody's happy. Nothing bad has happened yet. And then the VCs are also happy. So then, everybody knows, everybody's an adult except that high school student who knows things go bad. But then you deal with it and then you move forward. So most of the time, what we do ends up in a Siemens product after a year. So it's a I think we have a good track record.
Great. Great. So Oliver, you come from a financial world. You went to the solar CEO world back in the dark days of 2007 and 2010, and you've survived. And you're in investment banking at the moment. So tell us a little bit about your current. We'll also be willing to hear a little about your journey, but more about your current gig and who you're funding and what you're funding.
Great, thanks. Yeah, and thanks for having me on the panel here. I appreciate it. So I'm with Media Venture Partners, which is a San Francisco-based investment banking firm. It's 25 years old, and like any investment bank, we provide financial advisory services, which is we raise money for companies, and we advise on mergers and acquisitions. And so I came to Media Venture Partners a couple of years ago to start the Renewables group after a stint as a Greentech CEO of a power electronics company called EIQ Energy. And our thesis really...
I keep putting them on my dead list, and somebody
Yeah.
keeps saying they're not dead, so I took them off.
Still
this year.
around.
I took them off.
So Media Venture Partners focuses on industries where there are recurring cash flows and significant infrastructure investments. And so the company started in financing radio and TV stations and expanded into telecom, and specifically wireless towers, which are, from a financial return point of view, very similar to renewable assets, especially solar. And
And you're not the only company that comes from that cell tower background. There's a company, Dividend Solar, whose staff is also a bunch of cell tower financiers. So
That's right.
It's gotten to the point that solar is just infrastructure like a cell tower, right?
Exactly, and you know what's very attractive to institutional money managers is the very predictable cash flow that comes from renewable assets, especially solar. So anywhere in the world, the solar resource is extremely well understood. Solar technology itself is fairly low risk. And so the amount of energy that can come from a solar system is well understood. And if you have a solid contract to sell that energy to a utility or a big corporation or a school district, you've got a financial asset that is extremely valuable because it provides an investor or an owner of that asset with a very predictable cash flow over 20 years. And so we thought that we could bring investors who had previously been financing the telecom tower rollout, which really started in the 90s, and which essentially has gone through a vast consolidation stage and reached maturity. We thought that those investors would find the risk-reward of solar assets very attractive. And we've kind of proved that out. We closed a transaction last year whereby we brought a large telecom investor called Tree Capital. They invested $50 million into a solar development company. The solar development company had 400 megawatts of these contracts, they're called PPAs, with the California utilities. 400 megawatts is a lot. That's like a small nuclear power plant. And essentially, that portfolio of projects is getting built out right now. And what you're going to end up with is a very large portfolio of cash flowing assets. So these are really kind of the owners of these assets are the ultimate owners and they're
customers,
yeah, customers and demand drivers for renewable assets. And so there's really almost insatiable demand for solar assets right now with the yieldcos coming out, and we can talk more about that.
We're a
So-
media house, and if we see $50 million deals, we kind of skip them when reporting them because it's things are at $100 million and $200 million increments
Right.
that are going into residential solar financing, and so it's just another $50 million deal. 5 years ago, that would have been the mother lode, and now it's billions of dollars going into it. But clearly, there's a horrible gap. You can get solar financing, but you can't finance a new technology, and that's why the early stage investors are here. But there's a gap, and it is a tragedy that VCs aren't here to do this complete handoff. Let me ask a quick question to the retail. Oliver, you lived through the great solar scare of 2008. Are we going to ever see a $8 billion VC VC year, or is that's never going to happen? We're
You
gonna
know,
they're going to have to all die off. All those.
No, I think there's room for a lot of innovation still, and it's going to require capital. I mean, it's not exactly clear to me where the innovation is going to happen. I mean, it was interesting you mentioned 3 successful solar companies. Solar City, Sunrun, Clean Power Finance, those are all finance companies. They brought financial innovation to the industry, which made the growth of the industry possible. They're not technology companies.
All right. Well, but if solar is just like an infrastructure play, you don't need technology. You just need finance for it.
No, you need technology because you need performance and you need reliability and you need innovation to make sure that cost curves keep coming down and that you can ensure the continued demand in the asset class from the institutional investors that are out there.
Okay. All right. So for our retail investors, the 3 on the side, Jeff, you wanted this question. It's a fun question. What are the Playboy Bunny? What are your turnoffs when an investor comes to you and asks what to invest in? What are the common mistakes that an entrepreneur is making that when you see that presentation and you're being kind and polite, but in the back of your mind, either your head, your heart, or some other body part just said, this is not an investment I'm going to be making. We have a lot of entrepreneurs. What mistake are they making?
Did you say Playboy Bunny?
Yeah, I think I did. You know,
Okay.
they invited me. Larry invited me here. Turn-ons, turn-offs. What's your turn-offs on an entrepreneur?
All right. Well, we always feel at the band we can give an entrepreneur something. We can give them advice. We can give them feedback. We can give them contacts. Hopefully, they're open to our input. Maybe they're an investable company, and that's something. But I think for me, there's a number of things that would fall into the turnoff category. People that really see this as a mission-driven opportunity instead of a business-driven opportunity. Investors aren't going to invest in a mission. And we see a lot of that. Companies that maybe really completely underestimate the market opportunity. This is not one that came through the band. This is a company that I worked with a couple of years ago. Maybe some of you are familiar with the Cheng cycle.
This guy comes over to you, his name is Elon Musk, and he says, I want to change transportation. You're going to say, no, that's a mission. We want to see a business.
Yeah. Well, and we had an Elon Musk come in a couple of weeks ago. I mean, a tremendous visionary. He's going to essentially build the Tesla of energy services companies. He's going to be the residential, small commercial kind of service provider. He's going to do everything that somebody living in Los Altos Hills wants or needs for their energy. But is it transferable to others? Well, Elon's transferring his Los Altos Hills Teslas to other areas as well.
Palo Alto customer.
Maybe, but you see them everywhere. My point is that the visionary CEO does exist, and we see him come in, and we sometimes go, "It's a little too scary. That's just way too out there for us. Margins too thin." Da, da, da. But he was a potentially very transformational guy. I should look up his name. So maybe some of you here know him. I was really impressed with him. Oh shoot, and I can't remember the name of the company right now either. Larry, do you remember the gentleman I'm talking about?
Not offhand.
Okay.
All right, well, wasn't that visionary?
So, but that's part of the problem, isn't it? Is that if we're going to just concentrate on incremental improvement, if we're just going to invest in things that just make things a little more efficient or save a little bit of money here, that's not going to really garner the kind of interest. But yet, that's what we understand. It's the innovative stuff that's off the charts that are completely unexpected. I'm waiting for the company that's going to come in and say, okay, we've got wireless electricity transmission
Kacy,
figured
you must
out.
get this every day, right? So what barring physical laws invalidates a proposal for you? What is a a red flag?
2 weeks ago, I had somebody come to me and say, imagine a world with no continents. And then describe how his technology is going to change the future of energy. That's kind of a little too crazy for ARPA-E. I don't want to imagine a world without any continents. But the majority of the time, we get people coming in and pitching, and I guess they're used to pitching VCs, so they're telling us how this thing has been proved out and it's not risky, and then why should we fund it? So I think there's that problem. The other big problem that we see in applicants is that they haven't done like a rough techno-economic analysis. They don't understand the true costs of their system or what they're going to be competing against, not only today, but 5 to 10 years from now. So because ARPA-E looks at everything through that lens of impact, we need to know that, that you can take this to the market and that it can get out there and compete.
Okay. And Mark Perutz, what about you? What you have? What in your pattern recognition is a red flag when you see entrepreneurs come into your office?
Yeah. Well, I think our firm doesn't like to take on what we call science projects, and that's just a personal thing. Some venture firms do, like COSLA likes those, comes in super early where there's a lot of technology risk. Is the technology going to work? Our approach has been not to take on those, and that's kind of throughout the whole 11 and a half years we've been investing. In times when it's hard to get, there's not a lot of other investors around, it's hard to get capital, then we're a little bit scared of companies that require raising $100 million to build that first factory or that first project. And certainly if you have both, that's really scary for us.
Meet Brad Mattson of Siemens Technologies.
Well, the technology risk, we could talk more about that, but we don't see it that way. Definitely some capital risk, but the technology risk we're not concerned about.
I understand. So let's say there is a solar company that needs to scale up, and they have the technology de-risk. They have a dream team of thin film solar technologists on their team, and they need to go to that next step. They can't go to DBL for that $250 million. Do they talk to an investment banker like Oliver Janssen? Where's the next step?
The next step in terms of raising that, what stage are they at? Are they looking to raise the $50 million, $100 million for a first factory?
They need to build a 500 megawatt factory.
Yeah. Well, you could go to, you could get acquired by Solar City and then go to the New York Green Bank. It's just one way to go.
Good.
California's thinking about.
That's not repeatable. That's not difficult to repeat that.
Yeah, and it helps if you have Elon Musk as well to help sell that deal. I think if you've proven, if you've taken the technology risk off the table, so that's the first thing. You got to figure out some way to do it with some of the collection of the folks here on the table, angels, family offices, VCs, and you have a proven prototype that works. Maybe you've got a module that works on a small scale line, and now you're trying to take it to that point. Green banks is one way. California is working on it. It's really tough. There are foreign strategics that have a lot of money to put in, particularly in China. There are sovereign wealth funds. For example, I think Norway just announced they're going to invest $3 billion in 2015 from their sovereign wealth fund driven by the oil in companies. You could go to private equity funds. I think that they're kind of sniffing around the sector and it's not as scary and new anymore. And they have a lot of money. They can't do deals that are less than 50 million. But that's probably the biggest problem facing the industry, I think, is finding that money. And there's no great way right now. And venture was never really a great way for that anyway, by the way, because we're not built to write $50 or $100 million checks.
Let me ask the corporate guys. So I realize that you're not that you have this open innovation piece, and you're not a traditional, at least the Siemens gentleman is not a traditional investor, but there's sort of lore, venture capital lore, that it's difficult to work with corporates because your agendas are not entirely aligned, right? You have different expectations, different timelines. And yet, you guys are getting in extremely early. You're talking to two high school guys with a wood model, right? And if Siemens Ventures takes an investment in Cubotics, for example, in a seed or an A round, is that anathema to venture capitalists, or can you, is there are you finding that coming in this early as a corporate is a two-edged sword?
I mean, we don't have a financial goal. So, I mean, I don't particularly care if a VC is going to make money. I mean, we don't really do that. I mean, our venture capital guys care, but from our perspective, we are filling a technology gap, or we are alerting our product managers of a trend, because we see several, like this 3D printing, which is now everywhere. For a few years ago, we saw this trend. So our value is on these kind of things, and like I said, we do put the money in, and we do want the VCs to come in because our money gets multiplied. But whether it's a good deal for the VC or not, I don't know. I don't care. They know what they're doing, and I'm sure if they're putting their money in, they think it's a good deal. And the kind of interactions we have with the VCs right now is either their companies, they've already invested in it, and they want Siemens to buy it, and sometimes we are dumb, and sometimes we think they're dumb. So it's not always doesn't work out, but sometimes we both think it's a good idea, or they want us to kind of evaluate it, and we go together, and that's the kind of things we need. I mean, it's an interesting combination, it works sometimes. It doesn't work all the time. Yeah.
So Oliver, we have to, I think, shift over, because you're talking about cash and velocity of funds in your job. So forget about the technical innovations. Are there financial innovations? I mean, we watched Solar City launch their first asset-based securities, right? They were getting cheaper money because they were able to access a different, they're securitizing a pool of their projects and raising debt on that pool of projects. Forgive my lack of financial sophistication. I hope that made a little bit of sense. Are we seeing are REITs, MLPs? What are there new? Is building solar just like building a piece of infrastructure, or can we? Is the heft that we have in capital able to be imposed on solar now?
Yeah, I think so. I mean, we're still very much in an asset formation stage where the industry is growing extremely rapidly in terms of the number of systems that have been deployed, whether it's in that we've got explosive growth in the residential markets, and those companies are able to pool their individual rooftop leases into large portfolios and securitize them. I think the securitization markets are always hungry for this kind of product that can be sliced and diced. The real innovation was that Solar City was able to offer its customers a solar lease that didn't require the customer to write a $40,000 check for a rooftop solar system, and delivered an immediate 10 to 20% savings over the electrical bill. So that kind of made solar a no money down kind of proposition for consumers. And since in sunny places like California with very high electricity prices, the cost of solar energy is lower than the cost of conventional energy, right? It became a no-brainer. And so I think the real innovation was the individual solar leases and PPAs that the Solar Cities and the Clean Power Finances and the Sunruns made available. I think that seeing large institutional private equity firms aggregating billions of dollars worth of these portfolios and building platform companies to do that, with a specific goal of securitizing them later, shows you that there's just there's
and this rush into yieldcos.
Yeah, and a yieldco is essentially a synthetic MLP, right? I mean, so MLPs require.
Got that? Got that? It's a synthetic master limited partnership. Tell us what a synthetic MLP is, please.
Well, so an MLP is a form of ownership that was created by an act of Congress that essentially passes income through to the shareholders, just like if you're familiar with LLCs.
It's commonly used in oil and gas, but there is actually a rule that it can't be used for renewable energy. There's actually a rule that says it can't be used for wind and solar.
That's correct. It's not currently allowed. So yieldcos are the financial markets response, which essentially are baskets of operating assets. NRG has floated one that is a combination of natural gas plants, hydro, wind, and solar, called NRG Yield, which was very successful last in an IPO.
So it's a way for a public company to realize more value over the pooled
So-
asset of projects that they own, right?
Correct. Well, it's a way to have the cash flows be valued at a lower discount rate in the public markets and essentially
Are you
hand a
enjoying
large...
this conversation on finances of renewable energy projects? Welcome
So
to,
no,
welcome to our lives.
do you
Let's-
let me just, do you realize that all of the solar is not even 0.5% of the energy?
Yeah.
So she's talking quads and we're talking megawatts. This is like orders of magnitude up. So you guys are talking on
Yeah, but what's the current growth rate?
30% a year every year for the last 10 years.
Yeah.
so yeah, 30%. You know how long it will take to catch up to wind?
Siemens sold their entire solar assets because they didn't think it was a big enough.
No, we saw that because of what he said, is the innovation is in the financing side. There is no technology there. There's no technology. It's all in financing.
I agree. I read Greentech media. Most of our writing these days is about money rather than solar efficiency. So let's talk a little bit about clean tech sectors, okay? If a solar company came into the band, I know you're not immediately closing your doors because it's solar. Is that right?
No.
Are there any particular sectors that you have that are anathema? You stay away from water. You stay away from. Is there something that just you just say water has? There's no money making opportunities in this technology.
No, absolutely not. I think, given all the entrepreneurs that are in the audience, there are good ideas out there. We're looking for transformative early stage stuff. We want stuff that's going to make a big difference. And obviously, we're willing to talk to you when you're early and new at this. But we do expect our companies to come in and understand their the risks that they're facing in a highly regulated environment, the market opportunities that are maybe very limited. I always get a kick out of companies that come in and there's only one or two people that are going to buy their products. So no, I would say absolutely not, Eric.
Okay.
That we're open to any and all, but they need to be transformative. They need to really be exciting opportunities, and the incremental stuff, I can tell you, doesn't push my button much.
Okay. Kacy, is there do you say, another space space-based solar plant? I will pass on this. I mean, is there something that?
No, I think it may be public, or we've been evaluating space-based solar in in the economics of which I think it's online. So yeah, we're willing to look at anything. We're funding fusion now. There's a current funding opportunity on the street for instead of magnetic confinement, it's mechanical confinement, which is pretty out there. So we're open to anything except incremental ideas that are being funded by other parts of the Department of Energy. So, the wind program in the Department of Energy has a roadmap on which are, modular blades and modular turbines for assembly on site. That's on their current roadmap. They're funding that, so we probably won't fund that.
Okay. And Mark Perutz, is there a DBL code of investment thesis that says water's nice, but we'll let other folks take on that dilemma?
Yeah. Well, I think in this business, you have to be open-minded, and you can never write off a sector, because sometimes the sectors that everyone is writing off is where you want to play. Whether it's modules with SIVA, or water, which is a long history of basically being wandering in the desert. Sorry for the analogy of just not really finding a lot of venture capital interested in it and not having any notable exits. And water's really huge, from the industrial filtering and purification all the way down to kind of filtering in the home. But I mean, there's a kind of a resurgence in water right now. I mean, with XPV. Firm is focused, I think, mostly on water, Emerald Ventures as well, and EFW, Energy, Food, and Water. So I think we continue to see water deals. We'll do both incremental and kind of next generation things, as well as really big ideas. We won't sniff our nose at an incremental deal if you can get in with low technology risk at a really low valuation, like $10 million pre. And then sell that company at, $200 million, and that's a 10 to 20x depending on how much dilution you have. So I think there's opportunity at all ranges. And from a VC standpoint, it's nice to have a few incremental type bets and a few kind of bet the farm bets.
Oliver, let me ask you from a project basis, what doesn't? There's lots of money going in, and but what are the more risky types? Is there any appetite for technology risk in a project development world?
It really depends. I think in the residential markets, there's a lot more. There's been a lot more penetration. For example, you've got microinverters that Enphase, for example, has 40% of the U.S. residential inverter market without having penetrated SolarCity as a client, because they're extraordinarily risk averse. The risk aversion really comes from the way which projects are financed. We have tax equity investors in the United States who, tax equity is an important component. Basically, you're selling the tax benefits associated with a project to an investor. And there's a demand supply imbalance, and so they're able to drive many of the deal terms, and so they tend to rely on very conservative design and engineering firms and consultants who aren't really incentivized to take risks. But there are cases where the value proposition is so compelling, like in the microinverter case, where no question the microinverter made the design and installation of residential solar systems much simpler and much quicker. Even if it was more expensive, not SolarCity, but the others could do more installations. And so, there are also areas where different module technologies have an advantage, depending upon the application. And so there are definitely, and different module technologies are obviously project financed. Crystalline silicon is the most common, but thin film installations are commonly financed. For solar is obviously a big player in the market. So, but I think that a lot of the innovation right now really is around the optimization of systems, the data collection, the O&M, which is the operations and maintenance of the systems.
Becoming a big business, right?
Becoming a big business.
All right, I'm gonna. We have some questions that we received earlier from some folks attending, and so let me jump into this. So the question is, how big of an opportunity is energy storage? I report on energy storage every day, or my company does, and sometimes I wonder if we're in the midst of a public relations singularity, or if we're actually, if there's actually movement happening in this market. So,
it's a big opportunity for who?
So, answer. Is it a big opportunity? Is energy storage an enormous opportunity for Siemens? Are you looking at batteries? Are you looking at storing energy in form of steam, lithium-ion batteries, flow batteries, moving rail cars around and using mechanical energy? Is storage part of your thesis in energy?
Yes, of course. Storage is a very big part because from the wind farm, which is several hundred megawatts, all the way down to the home where there's like a few kilowatts. There's a role for storage, and there will not be the same kind of storage along the way. The way we're looking at it, the immediate, after Tesla's in an electric car, the next immediate thing is going to be storage combined with solar on the roof. And that has a lot of ramifications because of solar without storage on the roof is causing havoc on the distribution grid. So I don't know how many realize, but in Hawaii, you cannot add solar on your roof anymore because the Hawaii Electric is banning that. And there's a lot of fight. And because
There's
it doesn't...
2,000 interconnection applications.
6,000.
6,000 waiting to be interconnected.
Right. So this is a big issue. So hopefully that will get up. And then if you can have storage with wind, that is like a huge game changer. And that is not going to be lithium ion. And that is not going to be flow battery.
Yeah.
So that is a huge game changer. And then
Did you say it's
people...
not going to be lithium ion?
No, I don't think so. I don't think so.
Okay, so obviously people are making $5 billion bets that that's not the case, right?
They're putting lithium ion on wind farms.
Oh, yeah.
Oh, good luck.
Okay.
They've been catching on fire. They can barbecue on that. That's not going to work. I mean, it's too expensive. I mean, they're all funded by government stuff. This
You
is
know,
not
this
really.
is if this is the way Siemens feels about lithium-ion batteries, it's pretty important to understand that.
No, our use of lithium. We have lithium ion. In fact, we announced a big partnership with LG. It's not going to be in the wind farm. It's going to be on the distribution grid. That's where it belongs. In the home, we don't play in the home, but others are going to put it in the home. That is there. But the big value of storage one of the big values, many values. One of the big values is putting in a wind farm, and in a wind farm is not cost effective. So for that one, I don't think flow battery is cost effective either. So it needs to be some kind of thermal storage. It's not there yet. So it's something that has to be worked on. So there is value there. So the short answer is yes, there is value to be made. Different kinds of storage for different parts of the grid.
Okay.
That has to happen.
Any storage? Just jump
Yeah,
in.
I mean, the CPUC in California it basically mandated the utilities to acquire a gigawatt of battery storage. They've started with a first 50 megawatt solicitation, which is very small. But a gigawatt is several $1 billion. That's a big market, and that's going to drive a lot of funding of different storage technologies, and the market will decide.
But
Right?
the wording in that mandate is something to the effect of if it's cost effective compared to other conventional assets.
Right. Yeah, so this is one area definitely where technology will make a difference, right?
Okay.
So there's a lot of different approaches, and I'm not an expert, but you know, the demand, the grid is antiquated as you know, whether it's in Hawaii or in the continental United States. As the penetration of renewables increases, the grid becomes unstable, and the battery storage systems are just required to maintain grid stability, and so at some price point, it will make sense.
Okay. However, I would say, since you asked my opinion, today, if you had storage at $0 per watt, I would suggest that you still couldn't get it onto the grid because utilities don't understand how it fits into their world or how to make money off of it.
That's right. There's no revenue stream
They don't know how to make
associated
money
with it.
off it.
No, it's true that that needs to be worked out. But but by the same token, you know, some of the large owner operators that we work with are fielding requests from the utilities for proposals on 20 megawatt hours of storage or 40 megawatt hours of storage. These are very, very large industrial installations, and you know, that's going to take a technology solution.
Using lithium-ion batteries?
20 megawatt. The California grid is gigawatts.
Yeah, 30
This is
30
nothing.
gigawatts.
This is like having a little splash on your face when you're thirsty dying.
So AES just won a solicitation in the Southern California Edison LCR, Local Capacity Requirement RFO, for a 100 megawatt hour battery. So that's starting to get. I know we're not in quads yet, but I mean that's a pretty big battery.
I mean, of course, lithium ion is like a big role, and a lot of this is where you put it and what you're doing with it. And where you're putting it right now, it makes sense to have lithium ion. I was mentioning in a wind farm where you have 400 megawatts of capacity, putting a 20 megawatt battery isn't going to do anything.
It isn't GE. GE has an offering where they have storage coupled with a turbine that they're selling.
Absolutely.
As
But
a
it's
test.
very small.
Yeah, it's
And
I
they
mean, it's like
haven't
And
sold
it's used
many of
for
them yet,
firming
but-
and doing. We don't want to pick too much on the Siemens guy, but I think it's illustrative because Siemens has been building turbines and synchronous spinning stuff for 150 years, and they want. And if it's thermal, they understand it. They know how to boil water, and that's what they do. And so, boiling water and holding on to boiling water, that's what it is.
I see why you were fired from Siemens.
I quit, and they hired me back. Really.
We don't boil water.
That's absolutely true. And if you talk to I'm sorry, I'm a moderator, should be talking. If you talk to the Cal ISO, they're also of the mentality, they like spinning things. They like stuff that spins. They don't like electrochemistry. That's not something they enjoy.
Or demand response.
No, we have demand response software. We have all that stuff. If you just have to kind of appreciate the magnitude of things. A single wind turbine offshore is 6 megawatts. Okay, so 6,000 kilowatts. So how many kilowatts of battery you want to put in there? That's not going to work. It's just simple math. I mean, if you can do it if you have whatever 6 kilowatts or 3 kilowatts on your roof, you can add it a little bit, but
So this lends itself to that PR singularity I was talking about, right? Where storage may not be as applicable, and there's a bit of hype going on about it. Let's take some questions from the audience, please. You have to be mic'd up, so if you have a question, we'll bring you a microphone.
The 2 microphones are up there, and we got 2 people.
So don't be shy. We have, like I said, 400 man-hours of
there's
energy
another one there.
experience up here. You should avail yourself to it.
You can share the lapel mics up there somehow. Oh, we got some. Okay.
Brad Mattson.
No, I still wanted to start. Just real quick, Eric asked most of you, but I don't think we heard from Phillips in terms of the areas that you're interested in. What areas of technology you're investing in?
I think if you kind of define upstream and downstream, the downstream areas that we're not interested in is the component level parts, just pure LEDs. Some of these really small components are entering into the commodity stage of their life. What we're interested in is more of the systems, the data applications, and most importantly, the services. I think you'll see Philips really looking at systems and services as a revenue growth option over the foreseeable future. And I think professional connected lighting systems the infrastructure lends itself well to moving into those more interesting areas.
Like a PPA for lighting? Is that something where lighting services?
Absolutely. We already did a couple of deals where if you introduce a financing arm, we can finance an upgrade to a customer, and the customer pays out over the course of 10 years, and that is essentially as lighting as a service. And I think we'll increasingly see that if you take the concept of yield cos and turn it around, that we could begin to sell lighting upgrades for no money down, so to speak, and have customers enjoy the benefit over the course of
So it's like securitizing an ESCO kind of
right.
thing?
Yeah. Philips might even can be positioned as an aggregator of demand response with its ability to touch lots of customers and have the ability to dial back almost imperceptibly light intensity in certain areas of a building.
Is all yours light related, or are there other fields in clean tech?
It starts with lighting, and I think it builds out from there, but the lighting grid is the infrastructure on which we'll build more like a sensor networking platform, which will become a data-based business over time. We're not going to get into building automation systems or BMSs or that sort of thing. We're not going to compete with Schneider Electric or Johnson Controls and that sort of thing. Siemens.
We do. We boil water and we build managed buildings.
Yes,
I've got a mic. Sorry.
do it.
Great. I'd love to go back to the challenge around that kind of $50 to $150 million challenge when you get to that stage. Oliver, you mentioned that for solar, it's a cash flow business with high capex, and so that's something that can be financed. Talking about maybe a different technology, like let's say second generation biofuels, sounds like you wouldn't fund the first plant, but at what point do you start to feel that technology is de-risked enough where it would fit that model? Is it the 5th plant, the 100th? And between the first and that 100th, what are some of the other options that you can be looking at? Could we go back to that?
Yes, I think I'll start. I'm sure other people have ideas here, but I mean, I think the key thing is, are you building a demonstration plant or do you have a customer, right? I think that if there is quantifiable end user demand for the product, whether it's energy or the biofuel, then there's going to be a way to finance the opportunity. Right, that's the key thing. There is this kind of gray area between the demonstration project where you have to get to a certain scale to show your yields, your production yields, or your costs, and actually landing that first customer, big customer that would justify adding to the infrastructure, and that's kind of a gray area where we've seen in the solar space, where owner-operators, and I use that term to describe people who want to own the asset for a long time, right, will stretch in order to get control of the opportunity, will stretch into the development of the projects at an earlier stage. And they'll risk a smaller amount of capital to fund the early stage to get some kind of exclusivity or to own the more mature product.
Yeah, I thought
I
it
want
was
to avoid the question on the 5th biofuel factory you need to build. I can understand.
well, we're invested in a biofuel company, and I think you're right on in terms of the demonstration that hopefully takes 5, 10 million, maybe 15 million. But if you're going to build a real plant, it's going to be at least 50 million, maybe 100. And it's really difficult to get venture capital money for that right now, considering what's happened in biofuels and biochemicals. And just how much money has gone in there and how little successes there are, even though a bunch of them went public. And I think the real answer is you need to have that off-taker like a Dow or Dow Chemical or ADM or any of those other major players who have a vested strategic interest in taking that on. And so then it makes it a complicated dance between maintaining those relationships, which is high risk, high return.
Or the Department of Defense. They're funding several demonstration facilities for cellulosic biofuels announced this year.
So, Eric, I'd like to generalize the question a little bit. You know, I think we all know this, but we don't always think about it in terms of the businesses we try and create in this sector. This is a very regulated industry. I mean, the energy business from top to bottom has got regulations and institutional incumbents, and it's got a lot of things that make you think this is a real market, and it's not. You know, just a couple of thoughts came to mind with regard to biofuel. We've got a mandate for biofuel. So is that a true market? Is that really going to scale? And we've seen, as these gentlemen know far better than I do, but I watched him as an energy commissioner, all the biofuel failures. The battery storage issue, you know, we had a company come in that's got a bigger, better, faster, cheaper flow battery, and they think they've got the competitive advantage over everybody. So what's the market they're going after? They're going after California, where we have our 1.6 gigawatt mandate for this stuff, if it's cost effective. These aren't true markets, and you've got to be careful about getting into these things. And investors, as an investor, I know I'm paying a lot of attention to it. Biggest one that I've not heard anybody talk about for years is not too far from here, Bloom Energy. I mean, they live off the self-generation incentive program. That is the primary source of revenue that was created in this state, and it keeps getting renewed. I wonder how. I wonder what. So I'm a little suspicious of any business that's going to depend upon these kinds of incentives or mandates. On the other hand, I'm a former regulator, so I kind of like mandates too. In fact, if I could just bring up one more little point that I think is important. I was asking Kacy this, and a group beforehand. She knew the answer, of course. Has anybody here heard of the American Energy Innovation Council? Anybody? So,
We have one person back there.
I think this is important. The mission of the American Energy Innovation Council is to foster strong economic growth, create jobs in new industries, and establish America's energy technology leadership through robust public and private investments in the development of clean energy technologies. We've never heard of it, right? Who is this? Norm Augustine, former CEO Lockheed, Undersecretary of the Army. Ursula Burns, Chairman, CEO Xerox. John Doerr, Kleiner Perkins. Bill Gates. Chad Holliday, Chairman, B of A. Jeff Immelt, GE. You get the picture. There's some heavy hitters in here, and I heard about these guys about 5 years ago when they were advocating for, amongst other things, that the government spend about $16 or $17 billion a year in basic energy research, basic and applied energy research. You know, we can't count on the entrepreneur and the investor to find our way through this whole thing. I am not very sanguine about energy storage, okay? It's got about 16 different kinds of applications, and some of them are going to be great niche markets, but I think most of the ones we're thinking about and talking about probably aren't going to work. But I use that as an example because if we had more directed research and policy around energy at the national level instead of the hyper partisanship issues that we deal with, I think we'd know a lot better where we're going and what we should be investing in. It makes it really challenging, I think, for the investor community to know where to go and for the entrepreneurs to know where to go. So I only bring that up because I think it's a key element here that's missing. Every other industry that's done really well in this country has had the benefit of a lot of basic research. I think that we're missing some good opportunities here and we're going to get left behind. So for what that's worth, that's my little controversy for the day.
Well, that's for sure. I mean, the electric utility industry spends less than the timber industry spends in R&D.
Less than the pet food industry. Did you want to say anything about ARPA-E?
Well, I think that council called for us to be over $1 billion a year agency. And what that would allow us to do is just to vet more options for the private sector to pick up. So, you know, that's our job to de-risk these options that end up having a public good impact.
That's the key word right there. De-risking the options
And
is what investors
it's
need.
not a hot potato to invest in basic R&D. It's when people start picking winners that there's a freak out, right? But basic R&D doesn't seem to have a grassroots maybe. Sir.
So yeah, my question actually builds really well on Jeff's brilliance and bringing up the.
Who says this?
There's a lot of entrepreneurs in the room and people that are trying to push these new technologies around clean tech, and then we've got a lot of folks that are from, let's say, the support or finance side, and then to me there's this third estate, which is the government or policy side that can really be powerful in this. So I think in the federal case, it's exciting to see that sort of large-scale top-down investment. But what I'm touching on is a little bit less of things that I don't think what you're doing sounds like subsidies. It more sounds like investment, but things that sound like subsidies, but are more about partnerships with particularly regional or municipal governments. So my favorite example right now is Prospect Silicon Valley and the tremendous model that they've set up as a public-private partnership and creating a laboratory for testing these technologies. Philips, along with Cisco, is teaming with the city of Amsterdam to turn the city into a sensor laboratory and doing tremendous work. And I'm proud to say that the Clean Tech Open is refocusing on engaging cities and regional and national policies for how we can support clean tech. So I'm wondering to the rest of the panelists, it's a bit of a softball for Mark, but what are the what do you see as the potential, or how can cities better engage when they can understand that there's fundamentally, in the case of Amsterdam or San Jose, an economic development upside to attracting and retaining talent, bringing these technologies, growing those companies, and having that as a model for how do we get these new technologies implemented to make our cities greener and smarter.
We are part of this Prospect SV. It's actually very good. We like it. There's another initiative in the U.S. which is Pecan Street in Austin, Texas, and it's between Austin Energy, and they call themselves the hippies of the utilities. It's between Austin Energy and the University of Texas. So they have wired up quite a few houses, and with PV, without PV, with electric vehicles, without electric vehicles. They're collecting quite a lot of data.
There's a V2G, a vehicle to grid program, I believe, as well.
I don't know if they're doing that, but there's a lot of Chevy Bolts in there, and GM is a partner. Siemens, we were there for about a year, and then now they've expanded it to Boulder, San Diego, quite a few places. So that actually is quite a big project. And Amsterdam folks went there to study that before they started this Amsterdam project you're talking about. So that's another one. It's pretty good.
There's a gentleman back there. And we'll take one more question after this, sir.
Yeah, hi. I've talked, during the session before this, talked to several people who are in the same situation as me, and there's probably many others here when I saw people raise their hand. I'm an entrepreneur, inventor. I've developed some technology. I've applied for a patent and a patent issued. I'm one guy. Okay, where do I go from here to take that to, create a service or product around this and take that out to a market?
The Greentech Open.
Well, please consider that. There's a lot more to being an entrepreneur than just the technical side of it, and I think the Greentech Open could help you in that regard. But the other way you could go is to look at this Energy Innovation Small Grant Program in California. They award up to $150,000, and there's no strings attached to that. I mean, you got a contract with the government, which is something I wouldn't wish on my worst enemy, but it's undiluted funds too, and that could put you in a much better place before you start talking to investors.
Also, if it relates to Siemens, you can send me an email. It's my first name dot last name at siemens.com.
As long as it's not a battery, right?
Only thermal battery.
All right. Let's take one last question, please.
So, if an entrepreneur were to pitch to you for 30 seconds, what would you most want to hear, and what would most benefit your host organization?
I think I can start. I think oftentimes what entrepreneurs miss is who is the customer and what pain point are you solving? What real problem are you solving? I've heard so many pitches that they lead with the technology. I've even made this mistake in the past in doing startups, to not focus enough on talking to a lot of customers and really understanding the customer pain point. And if you can start with that, and then talk about the technology second, it's a good start.
We ask four very simple questions. One of them is what you just said. What is the problem you're solving? Then how is it solved today? Why is yours better? That's 20 seconds. You have 10 seconds left.
Mark, the other Mark?
I can't improve on that. That's perfect.
I think that's a good way to end tonight. Is it? And Doug, do you want to say some parting words?
Yes.
Okay, before you present the gifts to our contestants.
Parting gifts.
So first of all, I'm going to advance the slide. This is the one you should have been looking at during the entire show, but oh well. So here are their good-looking faces and their names and everything.
It's our
so you can
pictures.
put the face and name. Unfortunately, Bruce Bauer fell and hurt himself just before we started and had to go home. So we missed him, and he has a very, very interesting business model. One of the questions I have in my own mind is that if we did this again next year, but made it a different set of novel ways to fund your startup, would that be a good thing to do? Yep. How many people would come to that again? Oh, that's good. Great. Okay. Versus what we did last year. Actually, you know, I have a hard time explaining what we did last year to some degree. And that's one of the reasons why we had a brainstorming meeting and we came up with this idea, because it's very different, more panelists, more diverse ideas, and so on, to kind of give you all, you know, some food for thought. And maybe, hey, I hadn't thought of that, you know, that kind of thing. In the past, it was more kind of conventional, kind of looking at the way financing maybe evolves from small to large, or variations on that. So we've had investment banker, VC, and so on. When we started out, we had 3 VCs and an investment banker. So you can see how things have changed in the area of clean tech investing. So it's been interesting, and I kind of like the idea of doing something like this one more time at least, because there's a whole bunch of others. We didn't get into foreign investment. We didn't get into sovereign funds. We didn't get into foundations, prizes, or whatever. And those are all, you know, other interesting areas that I would like to explore.
If I could add one more, is crowdfunding, Kickstarter campaigns. They're really beginning to catch hold.
You know, that's interesting, because we discussed that specifically in our brainstorming, and somebody at least said anyway that they didn't think that was really very workable in this particular sector. So, you know, you don't think so? And
well, people have raised a lot of money. Solar roadways raised $2 million. Kickstarter.
Crowdfunding for product revenue is a great idea, but crowdfunding for equity is not so good, because you get you have this trouble with a 506B versus 506C corporation, and right?
Yeah.
Okay, I don't understand that one myself, but I believe it. Okay, we're going to move on and wrap up here. First of all, we always talk about our coming attractions, and this is like totally different subject from what we're doing tonight, but we are doing a series on climate science, and this is the third in the series on the oceans. This is the oceans in a warming world. John Marshall is one of the foremost professors at MIT on this subject, and he also heads up the global climate model at MIT. So should be a very, very interesting time in January for those of you who maybe are doing a lot of what you're doing because you're concerned about climate change. We want to thank all of the panelists here very, very much. And as we always do, when we say thank you, we give you something for having come and done this, taken out of your personal time, and we really appreciate that very much. Tonight's gift is a bottle of it's Camus Belglos, right? Pinot Noir. I can't remember which of the, well, wait, I can't look at it. Which of the vineyards is it? Las Alturas in Monterey County. Look at that bottle. Is that something beautiful or what? Yeah. Take a picture of that, Bill. Thank you. So this is our gift to everybody tonight, and Larry's going to just pass them out to each of you to just stay there and receive your gift. That'll be great.
Thank you.
And thanks to our panelists.
Yes, let's give them a big hand.
Thank you.
And of course, thanks to you too, Eric. You get one too. So I guess you're going to go last because you're the last one on the list.
Can you accept this gift?
Thanks, Larry.
Kacy works for the government, can't accept. I'll take hers.
Oh. Shoot, that's right.
Yeah, sure.
No, she really can't. Oh, gosh.
Oh, my goodness.
I forgot all about that.
Thanks,
Kacy,
Larry.
what can I say? Thank you so much, and we will see you tomorrow. And Eric, thank you. Eric gets a different bag. Do you notice that?
You can pay for it.
All right. Okay, wrapping up, we want to thank very much
Pay for your
Silicon
own
Valley
gift.
Bank. This is, I think, just a great theater auditorium. Don't you agree? Really comfortable and everything. And this is probably our third or fourth time here, and I just think the food keeps getting better. I thought the food was just, so if that was Kim Stauffer put that on. If you like the food, you can applaud her too. All right. And for our MIT Club volunteers, Larry, of course, is our event manager. Thank you, Larry. as you can see down below, it takes a lot of people to put this thing on, and we appreciate both in the brainstorming session as well as actually the implementation. And then finally, must recognize our videographer, Hank Magnuski. Hank, you there? There he is. This recording will be placed on our website and also on MIT Tech TV. So if you want to go back and pick up a few points that you've forgotten or whatever, feel free to come on and take a look. And didn't put his name on here, unfortunately, but we should recognize William Bill Murray, our photographer. So he's capturing the event that way as well. And finally, happy holidays, everybody, and have a safe trip home. Oh.